Hello, everyone, and welcome to Fundamental Auditing, Chapter 9. Chapter 9 is looking at the control assessment and testing. So, internal controls were introduced in Chapter 7, and Chapter 9 goes through more of what exactly are the uh, auditor's responsibilities around internal controls. And if we wanted to test internal controls, how do we go about doing that? So before getting into internal controls, let me just tell you the two different types of testing that we can do. So in chapter 8, we were looking at, doing inspection, recalculation, reperformance, all that kind of stuff. That was testing the account balances. So you have your financial statements, and it says that revenue is this much, inventory is this much, assets are this much. And we're auditing and getting evidence to see if those amounts are fairly stated and not materially misstated. There's another type of test, so that's called substantive testing. So substantive testing is testing the year-end numbers on the financial statements to ensure that they're presented fairly. So to provide an opinion on whether they're presented fairly. There's also something called test of controls, where we test if the internal controls of the company are working effectively and efficient, or working how they should be working. Doing a test of control, if if an auditor is going to be testing controls in the company, then they can reduce the amount of substantive testing that they do. So they have to decide, so that they don't always do test of controls. They always do substantive testing. They may or may not do testing of internal controls, depending on how the internal controls are set up by the company. If you understand the controls and the controls seem reliable, then you can test the controls to see if they're actually working the way that they've described them. And if the tests after you've tested the controls and gained evidence that the tests are working, then you could probably reduce the amount of substantive testing you do at year end, because you've already done some testing on the control process. Right, so that's just the two different testing that the auditors do. So internal control is the process designed by those charged with governance or management um, to provide reasonable assurance around the reliability of financial reporting and the effectiveness and efficiency of operations, as well as compliance with applicable laws and regulations. So it's basically the policies and procedures that the head, like those charged with governance, have set up, that is supposed to give you reliance over financial reporting. It's supposed to provide efficiency and effectiveness of operations and compliance with laws and regulations. So it's like the day-to-day, your day-to-day operations. What type of controls do you have around those? So management is responsible for its control environment and establishing internal control procedures. The cost of having controls is balanced with the benefit of the risk reduction. So it might be really costly to implement so many controls in your company. So like, for example, having like security guards that are controlling, that are watching your inventory, right? So that might be more expensive than having like cameras set up to watch the inventory amounts, like cameras in your warehouse, instead of having security guards standing around there. So management has to decide, like, what is the cost of controls? Am I getting the cost benefit of reducing the risk that something could be stolen? It's the internal or external auditor's responsibility to evaluate the whatever controls that exist, and assess the risk of material misstatement or control risk, right? So what auditors are doing is finding out, what does the organization do to avoid potential errors in the financial statements? Okay, so there's general categories of misstatements that occur where internal controls can help avoid these if they have been set up properly. So invalid transactions being recorded, or valid transactions not being recorded, unauthorized transactions being executed, transaction amounts are being incorrect or classified incorrectly, or recorded in the incorrect period. So those are like the general types of misstatements that occur in the financial statements. You could set up controls around this to kind of help make sure that these errors don't happen. Not 100, like you can't set up controls to have like 100% no errors, but you can set up controls to minimize the amount of errors. When looking at planning your audit procedures, you have to recognize what the IT environment is, and what IT, like data analytics, the auditor can use in order to help with the audit. So, and depending on what type of IT system the audit client has put in place, you need to understand the flow of all the information. So IT skills may be needed to understand the flow of some transactions, and that has to be considered in your audit procedures. Okay, so the client's computer processing should be considered in determining if there's any need for specialized IT skills. Audit team members should possess like sufficient IT knowledge, but they need to also know when they should call a specialist to come help them understand like the IT process that the client goes through to record their entries and to create their financial statements. So the more the auditors can rely on good controls, the less substantive work they need to do. So this is what I was talking about earlier. So substantive testing means, so there's like two types of tests the auditors do to get evidence, to get the sufficient evidence. So substantive testing, auditor has to do no matter what. This is where they look at the year-end numbers and do audit procedures around whether those are fairly stated. The auditor will have to decide whether they're going to test controls or not test controls. You can only test controls if after your understanding of controls, you think that controls are reliable. So if you gain an understanding of the controls and think, okay, these people do have good controls in place, you have to test those controls to see if they actually are good controls, right? Management can say, oh, we have segregation of duties, we get all approvals put in place, we do this, we do that, but you would have to test that they do that. So if the auditor can rely on there being good controls, they can do less substantive work at the end of the year. Okay? So if the auditor cannot rely on the controls, so if they understand the internal controls of the company and they realize that these controls are not very effective or they're not good controls or they're missing, then they're not going to test the controls because there's no point testing something that you know is going to fail. So then they have to do extensive substantive procedures. So auditors can, if they perform a complete evaluation of control and they assess control risk to be low and do internal control testing, they can minimize their substantive procedures. Okay? The most efficient mix of testing is control testing and substantive procedures, but you can only do control testing if the controls seem like they're strong. So you can't do that in every situation. So the process of evaluating internal controls, first thing you want to do is understand the control system. Phase 2 is assessing. So first you have to understand the internal control risk, and then you have to assess what your control risk, first you have to understand the internal control system, and then you assess what your control risk is going to be. So assign like a number between 0 and 1, and then depending on whether the control risk is low and the controls seem like they're good controls that can be relied upon, then you're going to test the controls. So let's go through each phase separately. So in phase 1, you want it to do this early on in the audit, obtain, information on the control environment, what are the flow of transactions, what are the key control procedures. So there's general controls. So basically like overall, that have an overall impact on the accounting process. There's application controls, which address like the inputting of data, the processing of the data, and the output of data on the financial statements. So general controls are usually preventative in nature. Effective general controls are required in order to have effective application controls. So I guess the most important feature of a control is the people who follow the controls. Right? So having a high turnover in the business means that there's inexperienced people performing the control functions. So that, like, if they're not, trained, if they're new and not really trained on it, then they can they probably won't perform the control functions as good as somebody who's experienced. New accounting officers or managers might not have sufficient experience to make the technical and judgment decisions, and which could lead to an error on the financial statements. Having management review like entries and schedules and financial statements all throughout the process is an effective control. Like, they can compare actual to budget, like on a monthly basis, for example, and then follow up on why there's a discrepancy, and maybe they'll find an error in the accounting because of that. So supervising is important. That is a good control that the companies can implement. Having segregation of duties or segregation of responsibilities is a really good control. So I was talking about how one person there shouldn't be just one person that is like collecting the cash, recording the cash, and depositing the cash. Same thing like for inventory, there shouldn't be one person purchasing the inventory and receiving the inventory, right? So you want to have proper segregation of responsibilities or duties so that people can't just conceal. If there's two people doing the act, then they would have to collude with each other in order to steal. So that's harder to do if you're just on your own. So the responsibilities that should be segregated are authorization to execute transactions. So who authorizes the fact that a transaction can happen, like purchasing inventory, right? Recording of transactions. So if someone's purchasing inventory, they shouldn't be the same person that's recording the inventory. They shouldn't be the same person that takes custody of that inventory when it comes in. And then periodic reconciliation shouldn't be the same person that's like, maybe does an inventory count at the end of the month or something to see if those existing assets are to check if the assets there are match what's recorded. Okay, so all these duties should be segregated by different people. Physical access to assets and important records and documents should be only limited to authorized people. So assets such as cash or inventory or securities shouldn't be available to persons who don't need to handle them, right? So like the inventory is going to be at the warehouse. Not everyone in your company needs to have access to the warehouse. Something like sales forms or blank checks should be restricted, should be locked, and only very limited authorized people should have access to that. Periodic comparison of recorded amounts to independent evidence needs to take place on a regular basis. So doing like bank reconciliations, counts of securities, doing inventory counts on a regular basis. And then that comparison should be completed by someone who does not have the responsibilities for authorization, custody, or record keeping. So whoever is doing the inventory count they should be independent. They shouldn't be the one authorizing the inventory purchases or having custody of them or recording them. So having good general IT controls are required before you can have the application controls. General IT controls is around the operating system. Who has access to the operating system? What type of passwords are there? Are they like strong passwords? Is there controls over the data center, the maintenance? Is there a disaster recovery plan? What is there backups, right? Is there regular backups happening, maybe weekly or daily? Is there physical security of the actual IT assets, so the backups and the actual system? Right, so that's all you're trying to understand the control environment and what type of controls there are. The phase 2 is assessing the control risk. Okay, so the auditor needs to make a preliminary assessment of control risk in their planning. So we have to identify control objectives, figure out the flow of transactions so you can find out where misstatements could occur, identifies specific control procedures that they have in place, what control procedures they have to prevent and detect misstatements. The higher the control risk, the more work is required, right, by the auditor. So the higher the control risk means that we would have to make detection risk lower, and a lower detection risk means more work for the auditor to do. We would have to, as auditors, document the control structure. So we'd have to document all the controls to show that we did have an understanding of internal controls. So we can do internal control questionnaires, like an interview, it is a checklist, do flow charts, like make a flow chart of how the information gets recorded in the gets recorded and financial statements are created, like who starts off recording the data and where does it go, basically. Okay? We can do a formal interview with the managers that have set up the internal controls. So it kind of helps figure out what questions to ask management. When assessing control risk, what we can look at, I guess a good way to analyze the control strengths and weaknesses is look at all the strengths. So the strengths are the controls that should prevent, detect, and correct the errors. If the auditor decides to test controls, they're going to test the strengths. The weaknesses are where there's a lack of controls that would allow material misstatements to go undetected. So you're going to analyze and document those. And then you can have like a working paper to connect the control evaluation and say these are the strong controls, and then you can set up the procedures for them if you decide to test controls. Controls for the IT systems need to be documented, but we also have to look at what are the manual inputting of information that needs to be considered. So the manual inputting of information, does it include approvals? Does somebody approve the inputting of journal entries? Does management review the reports? Does there reconciliations? Is there follow-ups? So controls in the IT system will be a combination of automated controls and manual controls, because somebody has to, the IT system can do the controls, but can create the financial statements and stuff, but somebody has to input those controls at the beginning. So there has to be someone that's inputting the data. So somebody has to first input the data at the beginning, and then the IT system can do its work. But whoever's doing that first at the beginning, that's a manual control. So we want to make sure that whatever's being done manually is being done correctly, because that's where all the errors can happen.
All right, so once you've gone through phase 1 and phase 2, so understanding the internal control system and assessing the control risk, then the auditor can decide whether they're going to, what the control risk is going to be, and then how much work the audit will require. And then they can also decide whether or not they're going to test. So here are the three types. Okay, so the control risk, if the control risk is assessed at low, then it seems that the controls are efficient, and then they can test the controls. So they can test the controls because it seems like they're good, and then they're going to test them to make sure that they're good. And this way they can do less substantive procedures. So a combined approach means you're doing test of controls and substantive procedures. And if it's cost effective to test the controls, they can do that. And control testing can happen at any point of the year because you're testing the processes, not the year-end numbers. So it's easier to not have to do everything year-end. You can do some of the testing during the year, and so that would allow you to do less work at year-end. Control risk may be assessed low, which is the second scenario, but it wouldn't be cost effective or efficient to test those controls, and therefore you would have to do substantive procedures only. Or control risk is assessed as high, and that means the auditor cannot test the controls, because if control risk is assessed as high, that means we've concluded that the controls are not reliable or not strong. So you wouldn't test, the only reason we would test controls is to confirm that controls are reliable. So if we already know that controls are weak, and then there's no point testing them, because then the tests are just going to fail. So then we would just do substantive procedures. So if the auditor decides that we're going to do control testing, so that means that control risk is low, then they can see how much, what they're going to test. They're going to have to do their planning on what their test of controls are going to be. So what they're going to be doing is determining how well the control is actually functioning during the period of the audit. So, management can tell you all these things, that there's all these controls being put in place, but you're gonna actually test whether they are working. Okay, so a test of control procedure is basically you figure out what the data population from what the sample will be drawn from, and then you do a procedure. Okay? So you do a procedure to see, if I input the price and quantity in the IT system of a sales order, will it automatically give me a subtotal and then automatically calculate the HST and provide a total? Okay, so that's the type of kind of test that you'll be doing. So there's control objectives that we need to look at when we're doing test of controls. Okay, so each control objective is intended to prevent errors that might lead to a misstatement. And control objectives kind of can fit in with the financial statement assertions we were already looking at back in chapter 6. So the control objectives, so the reason that you're gonna frame your audit procedures, your internal control procedures on these control objectives. So the control objectives are validity, completeness, authorization, accuracy, classification, and proper period. So the first one, validity, is checking to make sure that the transactions are valid. Okay? So it's kind of like existence. It also covers like ownership. Completeness is making sure that the transactions are complete, nothing's missing. Okay? Authorization is making sure that the person has authorization to complete the transactions, or there's like approvals and stuff in place. Classification is making sure that that the amounts are put in the correct accounts, and then proper period is looking at cutoff, so making sure that amounts and transactions and everything are recorded in the proper period and not something from prior period or the future period. Okay, so control objectives are basically like the management assertions, but for internal controls. So when you're testing internal controls, you use control objectives. When you're doing substantive testing and testing the year-end numbers, you look at management assertions. An auditor may determine that not all the control objectives are met for a particular account balance. And if so, then more substantive work will be required in those areas. In order to, for example, so in order to test for completeness or for existence, you would have to take, so when you're testing for existence, you're going from the financial statements and you're vouching it to the source document. So like the shipping document or something. So that tests validity. When you're testing completeness, you go from the invoice or the shipping document and trace to the statements to find out if it's actually recorded properly. Okay, so if they have like if the company has a process in place saying that, in order to record a transaction, this is the steps that we follow, this is what we do. In your control testing, you would go through those steps to see if it's actually working. Testing may involve reperformance, so recalculating a discount. Like I said, like if you put in the quantity and the price, will the IT system automatically calculate the subtotal and then apply the HST? If there's any discounts, will it calculate the correct discount rate? So you want to do a recalculation or reperformance of that to see if it's being done correctly. Some testing will have it might be hard to get documentation, like documentary evidence for some tests. So you might have to do like inquiry and observation and stuff like that. I said that control testing can be done during the year, not necessarily year end. But when you do the control testing, you should cover samples or do samples that cover the entire period. So if you're going to do control testing, don't just test controls from like September, for example. Test the controls, like take some samples from maybe March, some from May, some from June, some from August. Don't just cover just one little period, cover the entire period when you're picking your samples to test. Another, I guess, responsibility of the auditor is, so auditor standards require that the auditor report any weaknesses in their controls to those charged with governance. Okay? So when the auditor is doing a test of control, or sorry, gaining understanding of the controls, and they find a whole bunch of weaknesses in the controls, it's the auditor's responsibility to provide documentation to management of all the weaknesses that they have. It's usually written in a management letter. Okay, so it's communicated to the client in what's called a management letter. So they're going to explain, these are the weaknesses we found. So the format that we use to look at in the management letter is you state what the weakness is, state the implication of the weakness, and provide a recommendation. So if you, in your assessment of internal controls, find weaknesses in the control controls, you state what the weakness is, what the implication is. So why, what's going to happen if this weakness doesn't get resolved, and then provide a recommendation of how to solve it. So that's another thing that we have to do as auditors. So after gaining understanding, we know that there's weaknesses in controls. We don't just stop there and say, okay, we're not going to test controls, let's move on. We actually have to communicate those weaknesses, provide recommendations, so then the company can maybe hopefully fix them for the next audit. Okay, so that is chapter 9. Thank you for listening and take care.